Welcome to a new wave of entrepreneurship. I'm Scott Stirrett, founder and CEO of Venture for Canada, and your host. The focus of this podcast is to hear from changemakers and Canadian entrepreneurs to learn about how they've developed their entrepreneurial mindset and skills. In season 4, we'll be chatting with CEOs, founders, and successful business leaders about their career journeys. I'm excited to dive into these conversations about how to foster your entrepreneurial mindset and drive. An experienced entrepreneur and venture capitalist, Matt Golden has focused on startups his entire career. He has been engaged in all aspects of building and guiding disruptive companies from their very early stages. In 2011, Matt started Golden Ventures, one of the earliest micro venture capital funds, with the goal of supporting early stage founders in their journey of realizing their vision and potential. Many funds later, Matt brings the same excitement when meeting founders building transformative technology companies. Matt previously led deals at BlackBerry Partners Fund and Brightspark Ventures. Thanks so much for joining us today, Matt. How are you doing this morning?
Doing great. Thanks so much for having me on the show.
So Matt, you have a JD MBA from the University of Ottawa. And one of the things we're always interested in at Venture for Canada is how one's education impacts their career path. So in what way did your graduate degrees impact your career trajectory?
Yeah, I mean, I always sort of keep it on the DL that I was a lawyer. But let's talk about it because it's a joke in that it's really is a joke because I'm quite proud of the fact that I practiced law for a few years at Osler, which is a terrific firm, and we work with them closely today. I think it really didn't. I mean, part of it was timing. You know, I went to Osler's from 96 to 99, so right in the sort of crest of the internet, first wave of the internet. And so I got exposed to and started doing a lot of early stage financings, and that sort of prompted exposure to a lot of the entrepreneur class that I became quite addicted to. I was always entrepreneurial and didn't really plan on spending my entire life as an attorney. But the skills that I picked up in law, aside from getting exposed to what ultimately became a venture career and founder career, were like the ability to really understand legal documents. I was I'm more of a big thinker than a details guy, and law forces you to build that skill. And so it became a really important learning for me, that ability to hunker down when you need to get into the details as necessary. But I think most importantly, when I became a founder, was really understanding how to accelerate and not let the legal process get in the way of getting deals done extremely quickly. And so, I think bad lawyers slow things down. Good lawyers can help you speed things up and be a real business partner. I think when you have that training, you can ensure that you're only working with the right kinds of lawyers and accelerating, which is always the critical component of being a founder, accelerating and getting things done quickly and effectively.
A lot of people think of lawyers as just sometimes going through and checking and the boxes and making sure everything's right. But to your point, the best lawyers are business partners. They're people who really provide advice beyond, oh, is this illegal? Is this contract correct? And they're actually providing you broad strategic advice that's super helpful. So you're an entrepreneur, you've built successful tech companies, and you're also an entrepreneur in the sense as a founder of a venture capital fund. And congrats on the launch of Golden Ventures 4 and the Golden Ventures Opportunity Fund. Can you sort of demystify or describe the process of what it takes and what are the main steps of raising and launching a venture capital fund?
Yeah, I think those steps vary greatly depending on whether it's your first fund or your fourth fund. And so let's talk about, maybe for your purposes of your audience, that first fund where you don't necessarily have a track record in venture. That's a lot more difficult, obviously, because you at that point you're really you need to get people to believe that you are going to be a sophisticated investor who can get access to the right type of founders, deals, etc. and really also on the other side knows how to run a fund from a governance perspective. And so I would say fund one was a lot harder than fund four. Now I had already been in venture for a period of time. So I had, some of that skill set. I also had a legal background. So I think there was some level of credibility around the governance component as well. But really in your first fund, you're really talking to high net worth family office investors more than institutional investors. And that, that's challenging. And now compared to 2011, when I raised fund one, prior to even bringing on partners, it was a very different environment. In Canada in particular, high net worth and family offices really were more prone to invest in oil and gas and minerals than technology. They just didn't see a clear path to dollars in tech. And so it was actually quite challenging. Luckily, I had a couple of anchor investors and raised a relatively small fund to get out of the gates. And fund one was initially $10 million and ultimately ended up being 16 million when we attracted our first institutional investor, but that was a year into the fund already. And then as you progress and you have a track record and you've built these relationships, by fund two, more institutional investors started to invest in the fund. And we've had partners who have been with us since, fund one, like Northleaf, or fund two, since like HarborVest and others, Kensington, et cetera, who have followed with us. And so you build up like a group of loyal LPs, partners, who really become really meaningful partners along the path. And, depending on the size of your funds, we have increased our fund sizes. You will introduce a few new LPs. And by fund three, we had diversified more into a lot of institutional LPs in the United States as well, and now more internationally as well for fund four. So, you want to build up a diversified LP base, but they're really looking at your reputation, your track record, obviously track record of all my partners, and the way, interestingly, the way they're often diligencing you, at least the sophisticated LPs, is talking to our founders, because they know that, the brand that you build as a fund is predicated on how you are as a partner. And, that combined with track record, obviously.
Absolutely. And by the way, it's been fascinating in the 8 years or so I've been doing venture for Canada and observing kind of the Canadian startup ecosystem. It's been interesting to see a lot of these kind of moneyed, storied, multi-billion or multi-$100 million Canadian families that traditionally were very conservative or invested in traditional industries. So for instance, the Hunter family in Alberta, or the Sobeys, and a lot of that, may have made fortunes in more traditional sectors, get involved in venture capital investing at a pretty significant level. It's been interesting, in particular in Calgary, Vancouver, and Halifax, Creative Destruction Lab, and the role that it's kind of played it's funneling a lot of very high net worth individuals to actively invest in angel funds. And you were very much ahead of the gate, because 10 years ago was a very different kind of landscape. So out of interest, when you were going and you were pitching those family offices to say, hey, put some of your capital into a venture capital fund as part of a diversification strategy, what was your pitch? What was the kind of the contours of what your pitch looked like?
There is a huge opportunity in Canada. The Canadian founders are extraordinary. While we will invest across North America because I had a network to do so, we think that there's a huge gap in the market in terms of amazing founders without the real mentorship to really get from point A to point B. And that the Canadian ecosystem coming out of, let's say, the 2008 financial crisis, which Canada weathered extremely well, and even the Olympics in 2010, where there all of a sudden was more of a winner mentality in Canada. And I think that sort of became more pervasive in that time frame. And so the pitch was, we have extraordinary talent in Canada. We often lose it to the United States. There are an increasing amount of exits happening in Canada in liquidity. And more of these super talented founders want to stay in Canada. Let's give them a reason to do so. Let's make sure there's capital to back them. We have a network. We have access to these founders. Let's back them. Let's help them get sort of from point A to point B, from C to Series A. And given my experience at BlackBerry Fund and having a network of VCs in the US, we actually think this is the right time for a small micro VC. And micro VC was a whole new segment at that time. So there wasn't really such thing as a micro VC. We were one of the first actual micro VCs. Maybe we were in the first 30 back in 2011. And we felt that these smaller funds were better tooled, particularly for these smaller tech ecosystems where we could take less ownership and attract like a top tier venture fund from the US. And as the Canadian GP landscape got better and better, also from Canada, but it was the right sort of instrument to work with these founders, get them prepped, and then attract the right kind of capital. It was a whole different market, but what was happening at that time was there was now sort of open source software, whereas prior to that, everyone had to reinvent the wheel. When they started a company, they needed $5-10 million. They had to rewrite all the software from scratch. And now you had this situation where you could really rapidly deploy products. And there were all these new distribution systems like, the App Store, where you could quickly test whether something might work for relatively low amounts of dollars. And so this sort of seed instrument made a ton of sense in terms of not crowding out the cap table, which could attract, great downstream investors, which we had a great network to attract.
It gives a ton of flexibility. And to the point about being able to potentially invest in underserved entrepreneurs in some of these more perhaps overlooked markets. And one company, I guess, to zero in on is you were a very early investor in SkiptheDishes, which is now one of the largest food delivery companies in the world. And was originally founded in Saskatoon and then kind of built in Winnipeg. What was the journey like of investing in companies like SkiptheDishes in a place like Saskatchewan that venture capital investors probably in a lot of places in the US had never even necessarily heard of?
Yeah, I mean, first of all, I'm originally from Winnipeg. So, I understood that sort of prairie mentality. And for me and for us as a fund, we're really looking for extraordinary founders. And with SkiptheDishes, probably fair to say we were a bit dismissive at first, just, because of location. Could you build and scale a company in Winnipeg, which I think had a big question mark at the time. But the founders were just so extraordinary, and what they had done in terms of gaining traction with so little dollars. They were so incredibly astute that when they sort of pounded on our door a second, third time, and I got on a plane with my partner Amit, and we went to meet them, it was just an absolute no-brainer that these these founders were going to be successful. And the market, although competitive already, the market was incredibly underserved for smaller cities. So 1 million people, lower than 1 million people, really didn't have access to the same sort of services that the large cities had. And all the major players were focused on winning New York and LA, et cetera. And their cost of acquisition for new customers was super high. SkiptheDishes was like, are you kidding? I mean, in Winnipeg, do you know how much they'll pay us to join our network to get free delivery in the middle of winter. So, it just made a lot of sense. But not lost on us that it was a bigger risk, and even financing it downstream from top VCs was difficult because can you attract the talent? Can you build it? Well, they showed that they could. But that was already 2014 when we did that deal. So, we were a little further along in the sort of history of Canadian tech, but not terribly. So they did a terrific job.
And it's a testament to how those investments can then also reap downstream extremely positive consequences for broader entrepreneurial ecosystem. Andrew Chow has been somebody who's spoken to Venture Canada Fellows. I've got to know a little bit. I can see how once you met him, and I know he had co-founders, I have not met them, but just from meeting Andrew, he is a super impressive guy. And I can picture, meeting this person, how you would immediately want to invest in, and team is so much of what you invest in when you're investing in any kind of initiative. And now for our listeners, background is Andrew is the co-founder and CEO of a company called Neo Financial, which is kind of in many ways Canada's leading challenger bank. So kind of challenging traditional ways of banking, and a huge kind of potential, and is now maybe 150 or employees or so in Calgary, also in the prairies. But it's an example of how that sort of investment in Skip and the building of an entrepreneurial ecosystem, it just keeps on compounding and growing. And Skip is still a huge employer in the prairies, but now you have new companies like Neo Financial that are also growing.
Yeah, and in fact, Neo just announced a 100-person office in Winnipeg. So, they're really, they know how to build in these smaller markets, and it's amazing because it changes the landscape. The impact it has on these smaller tech ecosystems is astounding.
Absolutely. I'm from the East Coast originally, so I grew up in Nova Scotia, and Venture for Canada does a lot of work in Atlantic Canada. And a great example is the acquisition of Verafin by NASDAQ for
Absolutely.
like over $2 billion.
Yeah, incredible. Yeah.
People can build a multi-billion-dollar companies from increasingly anywhere that you have high-speed internet. And it has huge positive implications for not just tech ecosystem, but the region in general, in terms of injection of wealth, angel investing capital, tax revenue. There's huge benefits.
Yeah, and I think I think the pandemic has accelerated the notion that you can build companies from anywhere now. And so we expect to see a much greater spread of venture capital dollars across markets, more so than we used to.
I completely agree. And I think that there's such a tremendous opportunity in mid-sized cities in particular. I think it's still challenging in very rural environments, probably to build, especially because of the most high-speed internet. But in places like Fredericton, Charlottetown, Saskatoon, Kelowna, I think that there's huge opportunities, also in the sense that there's often great talent you can get in these places that it's harder to poach. There's more loyalty. There's generally lower salaries, so lower burn rate. There's a ton of benefits. And there's also, it's very desirable for a lot of millennials priced out of major cities to move to these places that often offer really high quality of life.
Agreed. Absolutely. And I think we're going to see more and more of that. I think it's going to become even more challenging in some respects for these smaller markets, because large companies now are completely comfortable with remote work. And so that puts any talent anywhere as a target for these larger companies. So we're entering the phase of the talent wars. I can say that unequivocally.
And it's going to be interesting. I feel companies that have policies that require everybody to be in the office 5 days a week are going to be losing a lot of people in the next couple of years. And it's a testament about a lot of people moving to new places as a result of the rise of kind of work from anywhere. At Venture Canada, I've seen a ton of our fellow alumni move to the East Coast of Canada, where they're still working at Shopify and these big companies and earning the same salaries, but they're doing so in a place that costs 50-60% the price to live and offers a great lifestyle.
Yeah, it's a smart move. Now, the question is, do companies start adjusting for that cost of living? I think initially it was like, hey, go work from anywhere, so you don't have to be in the office. Then I think it's like, okay, well, if you are in the office and you're living in San Francisco or Toronto, maybe you make this, but if you live in Halifax, maybe you make not this. But it depends how competitive it gets for talent, because that will continue to drive the prices up.
And that's the point. Facebook, I think that they announced their work from anywhere is that they would index salaries relative to place. And a lot of people kind of freaked out, but that will probably be something that a lot of companies will roll out, because they'll see the opportunity to reduce, save a lot on doing, what's the term, onshoring. So not offshoring talent,
Right.
but employing people in lower cost jurisdictions within, the country that their head office was located. And by the way, a lot of companies, for our listeners, have been doing onshoring for a long time. For instance, Goldman Sachs, their largest office in the United States, other than New York City, is actually Salt Lake City, Utah. And they employ 6,000 people or so in Utah, because you can pay somebody working in different back office jobs like 60%, 50% in Utah what they would make in New York City.
Oh, absolutely. Probably even less.
Yeah, huge difference.
But it's just a cost of living adjustment, though, in fairness. I mean, and I don't think that's inequitable. I mean, there's no reason that the two people doing the same job in San Francisco and, let's say, Halifax should earn the same amount of money. I at least I don't think I don't think it's equitable to do that. And I think from a company perspective, I don't know that you want to incent people, because then the person in San Francisco is like, I should just move. Whereas there is, and I think people accept that there is a lot of benefit to having like at least a home pod to build culture around. And so it's going to be really interesting as we really get back to work to see just how much those sort of home bases matter for these companies. So I'm really excited to see that. From our perspective, we are counseling our companies to be quite flexible in terms of, not mandating you got to be back in the office, because talent is, there's a shortage of talent, and you can't afford to be inflexible right now.
And that's the same approach with Venture for Canada. We have 32 employees ourselves, so we're kind of a small organization, but our staff is just spread across Canada. And our approach is kind of like post-pandemic. You want to go to the office 5 days a week, you can go to the office 5 days a week. You want to work from home 5 days a week, you can largely do that. Although there will be certain times where people come in person and you can't 100% be remote. But we will try to accommodate people. And most people, I find it's like 20% want to work from home all the time, 20% want to be in the office all the time, and 60% kind of want a fusion. So freedom is key, I think.
I think what you're going to see is sort of mandated days in the office so that you can still build the culture and connectivity that really help an organization grow. There's always the water cooler talk is not really a fallacy. I mean, a lot of great innovation happens by having your employees physically together to not only build relationships, but to brainstorm and innovate together. And so I do think you lose something by not at least having some sort of consistency of connection between with your company. Now, if they're all over the continent, that may mean having offsites quite regularly, which is, I think, going to happen really frequently.
Yeah, having more kind of summits, or doing it even on a quarterly, annual, biannual basis, and investing more money in convening people together in that kind of way makes a ton of sense, particularly if you have staff that are all across the country or continent. Because I agree, there's, especially for brainstorming or camaraderie building, there's still huge benefits from the ability to meet in person with different people. Going back to kind of SkiptheDishes and your experience kind of sourcing deals, and I'm sure you probably met like thousands or like 10,000 kind of early stage entrepreneurs over the past decade. And you've invested in some of the most successful early stage Canadian technology companies, which are now huge firms. So companies like SkiptheDishes, which you mentioned, but also Fair, Clearco, Top Hat, WattPad. You have a phenomenal track record of really identifying entrepreneurs at an early stage who go on to build really successful companies. My question to you is, what do you look for when you're assessing a really, really early stage company and deciding whether to invest?
So we look at it like as a three-legged stool of, founder/team composition, and then market. Are they chasing a market that has sort of venture scale potential? Is the TAM there, or the SAM? And then what are the proof points that they have that they are going to be successful at this? And I think the analysis really starts with the founder team, and the founder composition. Going back years, but I love these terms. Like, is there the hacker, the hustler, and the designer in that sort of founder composition? And the more either experienced or more conviction we can get around that team composition and those specific founders, the less traction we really need to see. So it's just like a playoff. Let's assume the market's big enough. So we'll just sort of, like, because we just won't invest if it's not venture scale, because you're not doing founders any favor by putting venture dollars in something that can't get big enough. That's just a misalignment. But on the balance of founder versus traction, it's really about, like, just what level of conviction do we have in the founding team. And when you meet these special founders, you just kind of know, and we call it the shut up and write the check kind of founders, and don't outsmart yourself, which we still do, unfortunately, sometimes. But those teams are rare and they're special, and we look at certain qualities that really shine through. One of them is we sort of look at the rate of learning. So often we get to know these founders over a period of time, and we hopefully have the privilege of brainstorming with them a little bit on their business, and we watch how they learn and absorb information and how they apply that and how quickly they apply that. Because everything is really about rate of learning and then execution. And so if you see those really strong qualities amongst that founding team, and that execution comes across product and sales and even raising money, it's that sort of like special capability within that founder set. Those are really the core things that we look at.
It's interesting. At Venture for Canada, we use this entrepreneurial competency framework called EntreComp, which sounds a little wonky, but it was funded by the European Commission, and it's the most thorough definition of entrepreneurial skills that has been done in the world. It breaks it down into 442 different learning outcomes and 15 kind of competency areas. And the 15th competency area, which is also like the most advanced and what the European Commission's kind of research finds is like the most important, is lifelong learning. So I share this because I think it links is the most successful people, I think in general, in many ways, the most successful entrepreneurs are voracious lifelong learners. And their rate of learning is just so intense from the day they are a child to the day they die, that they're just constantly omnivorously gaining kind of that information. So I think that that's a really interesting insight you shared. Matt, it has been a true pleasure chatting with you today. Thanks so much for coming on the podcast.
Thank you so much, Scott. I really enjoyed it.
That's it for this week's episode of A New Wave of Entrepreneurship. Stay connected with us via our social and our email list. Subscribe to us in your favorite podcast app so that you don't miss our next episode. If you have feedback on today's episode, tweet us at Venture4Canada. That is Venture, the number 4, Canada, or email us at podcast@venture4, that's spelled FOR, Canada.ca. We'd love to hear from you. Thanks for listening. I'm Scott Stirrett, and until next time, stay safe, stay motivated, and stay grateful. A New Wave of Entrepreneurship is produced by Juanita Lee Garcia and Latifa Farah. Editing and mixing also done by Latifa Farah. Erica Ormanston is our editorial assistant. Mark Wallach and Premium Beat own the copyright and publishing rights related to the song used in this podcast. The comments and opinions, recommendations, or suggestions expressed on the podcast by the guests are not liable to Venture for Canada and belong solely to each individual. Any information provided, stated by our guests and our host, is independent of Venture for Canada. A New Wave of Entrepreneurship is a Venture for Canada brand, and all content is owned by Venture for Canada. If you'd like to use our content, please reach out to us at podcast@venture4, that's spelled FOR, Canada.ca.